Good morning, everyone. This is Curtis Hawks with Insurance Agency Marketing Services, and I want to thank you for taking some time out of your day to join us for, I think, a very important topic. I think you're going to be very pleased with the presenter that we have on with us today, and we're going to be talking about a variety of different things that are going on in the life insurance world today. Not just what's going on, but how that impacts things in the future. And it's all designed to really make sure that you're properly prepared so you can put together the best solutions for your clients. Before getting into that, though, I want to talk about some of the additional ways that IMS is here to add value to your business. First up is our new producer builders. So if you're a new agent with IMS, this is a great opportunity for us to partner with you on your business. And so you can see a variety of point totals up here on my screen. And whether it is different marketing campaigns or trips or just cash, we've got a variety of options there that you can cash in on. And what I would encourage you is if you've got questions on that or you're interested to see where you're at on it, reach out, talk to one of the sales directors over here. The phone number is 800-255-5055. In addition to that, we also have our IMS business builders. So for those of you that currently work with IMS, if you know of an agent who maybe isn't quite happy with their current IMO relationship or you think might be a good fit for us, send them our way. Not only will you get a $50 bonus when they get contracted, but on an ongoing basis, you can earn revenue off of their production. We take care of all the service. You don't have to do anything, and you get checks on a quarterly basis. In fact, those are some of the biggest checks that we cut out of here. In addition to that, we've got our marketing reimbursement program. And for every 100,000 of qualifying indexed annuity premium, you can earn $100. And then you'll see there on life insurance, we've even got that a little bit richer. So for every 100,000 of single premium life, you get $200. And for every 10,000 of life target, you can accrue $200 as well. And if you've got questions on that, reach out, talk to one of the sales directors over here. Again, the number is 800-255-5055. Back office support. I really think that agents, they understand the difference between a firm that really excels at support and firms that maybe they've worked at in the past that didn't have as good a support. And we really want you to be able to focus on what you do best and really support your business and help take care of the things that are necessary components of your practice, but allow you to do what you do best, which is helping clients. And so I would encourage you, if you haven't used our back office support, you definitely need to, whether it's from the case design to commissions to licensing to new business processing. We've got a singular goal, which is to help you get your business done quickly and efficiently so that way you can continue to focus on driving new sales. To that end, technology is a core theme with us. One of the ways that we deliver on our on the technology front is through the IMS website. As you can see there, we've got a variety of resources available on there, from quoting to e-applications to even our sales resource library has over 500 point of sale pieces that you can instantly download on the website. And it covers everything from how annuity basics, life insurance basics, to loan regime, split dollar and premium finance, and everything in between. And you can get access to all of that by just being a contracted agent with IMS. You just go on there, get registered, and you instantly have access to all of those resources. In addition to that, we do integrate with Firelight as well as iPipeline. And so right now, when we look at the marketplace, and this has been obviously growing for a number of years, but e-applications are certainly have transitioned to be the majority of how a lot of advisors do business. And so we've got it simple and straightforward for you to be able to access those via the IMS website. And so you've got one centralized hub for everything that you're doing. We've also got our creative department, and I think creative really is the key word. Your brand is more important now than it's ever been. We all used to, I think for the most part, focus on marketing in a local geographic area. And certainly I think we all know that that's not necessarily the landscape of the marketplace right now. And so making sure that your brand is out there for consumers to see and look at and evaluate all helps drive more revenue for you. And Our creative team, I think one of the key things about it is they just specifically focus in the financial services space. There's a lot of ad agencies out there that work with multiple industries. And the thing about the financial services space is it's unique. And part of the reason why it's unique is that we deal in intangibles. We deal in the promise of a guaranteed income for life. We deal in the promise that if something happens to that client, that you're going to be there with a check. And that's different than somebody that's running a clothing store or a restaurant or some other type of service-based organization. And so not all the best practices that you see in marketing in general necessarily translate over to the financial services space. And so you have access to a team of experts that specifically focus on the financial services space, and they've got one singular goal, which is to showcase the best version of you. So if you've got questions about what we have available with our creative department, reach out, talk to a sales director. They can chat with you about that. We also have a custom marketing analysis process, absolutely complimentary, that we offer, where we'll actually go through and do an analysis of all of your marketing assets and come back with recommendations on what we think makes the most sense based off of what your goals are. In addition to that, we've got IMS Wealth Management. This firm has been growing significantly since we founded it a few years ago. And we really see a trend in the marketplace where more and more advisors are adding AUM to a portion of their business. And so if this is an area of interest for you, I would encourage you to reach out, talk to Duncan and the team over there. They can talk about how they can help you to incorporate that, or if you're currently an IAR and you're looking to make a change. Again, great resource, and the team's been doing an amazing job and has been experiencing significant growth. I also want to mention our Life and Annuity Academy. Today we're going to be talking about trends in the life insurance space and how that impacts you. Our life and annuity academies, our life trainings are one of the best opportunities that you'll see out there in the industry to really take a deep dive on your business. So not just talking about life insurance, not just talking about annuities, but we're talking about industry trends, we're talking about marketing best practices, we're talking about sales and product positioning, we're talking about best practices from top advisors and what are they seeing that's working for them out there in the marketplace. And so it's a great opportunity for you to spend a couple of days working on your business. We've actually got our first Academy of the Year this week, and we've already announced our second Academy of the Year. That's going to be coming up June 7th through the 9th. And so if you have interest in that, reach out, talk to a sales director. Space on these is always limited. And so I would encourage you, if you do have interest, reach out, talk to a sales director, and they can chat with you about how to get registered for that. In addition to our live training events, we also offer a number of incentive trips each year. And so our Seaside Sanctuary, we're currently in qualification for right now. It's going to be in April next year. And it's just going to be an amazing event on Kiawah Island. There's going to be golf, a variety of different things that can be done. And it's all about relaxation, the beach, you name it. And so if you have questions on that, reach out, talk to a sales director. They can also get your point totals as well. We've got through the end of this year to qualify for that. Lastly, I'd mention to everybody to make sure to like and follow us on Facebook and LinkedIn. We incorporate a multi-vertical approach with our marketing and our content syndication. So not only do you get phone calls, not only do we do email, but we do a significant amount of content posting on social media. And so it's one of the quickest ways when we have a rate change or a new product or something along those lines that's going on to be able to get an update on that. So with that, I'm going to get this switched over. So I've got Jon Salomon with me on the call today. And Jon and I have known each other for, oh gosh, probably 12 years now. And I've had the pleasure of getting to work with him for a very long time. And what I can tell you is he's one of the most knowledgeable guys I've had the opportunity to work with out there when it comes to the life insurance space. And when we talk about cash accumulation, I mean, this guy can talk about anything and everything that you can think of. And so we've got some big things going on right now, which is AG 49. We've got the most recent iteration of that going into effect next week. And so I felt like it'd be a good opportunity to have Jon on the call with us today and kind of do a deep dive into, what do we know so far? What do we think is going to happen? What are some changes that we see coming up in the future? And then ultimately, I think what we're going to end up doing is probably doing a second part of this down the road in a little bit once we've got some more data from the carrier. So John, with that, I'm going to hand it over to you, and I really appreciate you taking some time out of your day to be with us this morning.
Well, thank you for the kind words, Curtis. It's interesting that you ended with, we're going to have to do another one of these. I was actually thinking that this morning. And in fact, we're so early, literally, next Monday is when all this is going to start. So if we postpone this till next Monday, maybe the following Monday after that, we'd have a lot more to discuss. Well, thank you for that, Curtis. Can you see the screen I got going here?
So I can see your email screen. So I assume you've got a presentation that you're wanting to go through.
So let me go switch to switch.
And while John's pulling that up, and he's going to talk a little bit about the history of AG49, this has been something that's been around for a few years right now. And so each time that we see, it used to be that you only had to look at pricing, updated mortality tables, and even that wasn't that frequent. And anymore now, it seems like every couple of years we've got some new type of regulation. I mean, heck, even what was it, January of last year, we had the change to AATR, which was the applicable accumulation test rate. And so those of you that sell a decent amount of life insurance probably noticed that last year, especially if you're working in the overfunding market, to where you saw that the death benefits looked dramatically different after those designs. And the interesting thing about that is that's something that had been the same for almost 40 years since it got put into place in the Deficit Reduction Act. And so one of the things that we want to make sure that we do an effective job of is when we have these types of updates that we're going through, how does this shape and adjust how you're positioning things? And does this have an impact on what carriers that you're looking at? And one of the things that I would tell you is the life sales team over here does a very effective job of making sure that they're current and up to date on these different types of things, and then what that net impact is. I know many of you probably even here over the course of the last couple of weeks have been seeing emails from some of the accumulation carriers, the accumulation life carriers, talking about updated rates, and probably have some questions around what that means, which is the core point of why we're on the call today.
Well, that was a good stall, Curtis. Can you see it now?
I think you still got to switch the screen presentation.
I switched.
That looks good.
Okay. Okay. Let me just start by saying this, people. Thank you for being here. And I put my name and number and my contact information up there. And inevitably, what happens is someone from this is going to call and say, "Hey, I've been doing some business with a couple of FMOs. Can I work with you? I like what you said today." And please don't do that. You just put me in such an awkward spot. I am here to help. Please call me with any questions, anything you have from today's presentation, any agents, any clients, anybody you're working with. I'm here to help you. I'm a consultant with Curtis at IULs. I want to do everything I can to help them and help you. So with that, let's just jump into it. So what I always like to start with is just this first screen. I always start with this I guess it's kind of my intro to the entire day, because what I really want to talk about today is all over the place. I'm going to talk a little bit about whole life, a little bit about index universal life and how to compare the two. I'm going to talk about the history of the products, the history of AG49, and interesting that Curtis mentioned, loan regime split dollar and one of the things that they cover. In analyzing older portfolios and talking about newer portfolios, we keep talking about, with small business clients, retention of really key employees. And I can't tell you, Curtis, how much of the loan regime split dollar, we're talking about it almost on a daily basis right now. And I want to go into a little bit, did index universal life blow up in the 90s, and what happened to, universal life blow up in the 90s, and what really happened with whole life. So with that, I'll jump into it. And I'll just say this. Doesn't matter what you're selling. You're doing life insurance, or you're doing annuities, if you're selling cars, any old widget that you're selling, you need to have some kind of an elevator speech. And I just throw these out there because this one page right here is just kind of my sales ideas and opportunities for you guys. And I love this little line, what do you do? Well, I fix broken insurance portfolios. What does that mean? Well, I'm going to talk about broken insurance portfolios in a minute in terms of someone that has an older policy that is on an old CSO table, someone that doesn't have a chronic or critical illness or any living benefits on it. That's the old kind or the new kind of insurance. And also, I love this line, life insurance, not the kind you've ever seen before, because of the quality features of index universal life, the opportunity to lock in your rates, to never lose any money, to kind of fight Washington, D.C. and what they're doing with taxes, and to fight the stock market and never lose your money. There's just some really cool things here. So as you read those little lines there, just keep in mind, what is it that you guys tell your prospects, someone you're standing next to, if you're one of those people that can talk to someone in a grocery store? I just like to have a quick little elevator speech. And also, and since I'm just real big in the annuity world, I just love to talk about the underwriting process real quick. And think about it, for a lot of the annuity producers out there that are working with Curtis and his team right now and selling annuities, but just trying to dabble into life insurance and didn't like the underwriting process, with what's happened recently with LexisNexis and all these different opportunities for instant issue policies, it's changed so much. So if you haven't done this lately, please jump in. And that's this third little line here, this contingent beneficiary referral. I throw this out every time. Curtis, you've heard me say this a few times. And I love this because it helped me when I was in the field immensely. I can't tell you how many referrals I got from it. And if you think about your own life right now, who is your contingent beneficiary? I mean, Curtis, think about your contingent beneficiary. Is it your brother? Is it, your best friend, your next door neighbor, someone you've known, your cousin? I know for a fact Curtis can get me an appointment with his contingent beneficiary on all of his things. And so if he's looking at any assets that he has a contingent beneficiary on an application, thinking about the life, the annuities, any AUM forms that you're using, there's always a contingent beneficiary there, and use that as a referral source. I absolutely love that one. And number 4, 5, and 6, I just like to talk about these every time, and I'll go into a few slides. I'll dive a little bit deeper. But, January 1st, 2009 is such a huge, huge, huge date for us. Anyone that has a policy January 1st, 2009 is on a 1980 CSO table. And I'm just realizing, Curtis, that I opened up the wrong presentation here, but it's okay. January 1st, 2020 is the wrong date. It's December 1st, 2020 is when we went from a 1980 to a 2001, and then we switched to a 2017 table. So think about that. I just want people to realize that, because I'll show you what the numbers are in a minute here. And lastly, I want to talk a lot about what happened to universal life in the 90s, because one of my little takeaways from these first few slides is just really chatting about, what did whole life do and what did universal life do over the last 30 years. I want to dive into that a little bit, because I think it's a really good place to pick up some money for you guys, pick up some opportunities. This is a really awesome slide. This is my whole life policy that I bought back in 1992. And it's interesting because if you look at this, you can see that this is my projections for year 28. And it's funny that I still have this policy. I finished paying on it. This is my last year that I paid. And if you take a look at this thing, my guaranteed cash value was $41,000. My illustrated cash value is $117,000, and my death benefit's $285,000. That's what I was supposed to have. So look at that. 41 is my guaranteed cash value. I'm supposed to have $117,000, and now it goes to $285,000. This is what I have today. Instead of having $285,000, I have $140,000. My guaranteed cash value, remember, was $40,000, and $117,000 was the current. I now have $52,000. Why am I showing you this? It's just one of the things I always hear about from the whole life fans are, hey, universal life didn't work. It absolutely blew up in the 90s. It didn't work at all. Well, I say kind of the same thing about whole life. If I'm supposed to have $117,000 and I only have $52,000, yeah, it worked. Yes, I'm still there. I'm only 20, 25% over my guaranteed cash value. But more importantly, I want to say this. If I put $1,200 into a universal life policy and max funded it, I would have a lot more money today than I do right now. And that's just a really important thing for me, because I can't stand it when I hear people talk about universal life. Oh, I sold a bunch of IUL and it all blew up. Well, did you sell it at Target or did you max fund it? No one was training people how to sell these things properly in the 90s, and that's my biggest issue. So I just want you to keep that in mind as I get through these next couple slides and we talk about the CSO tables. What I like about this slide is this is a Bleach study. I know this is old, but I just show it because what this guy did until 2014 when he passed away, he always went back 20 years and he looked at all the whole life illustrations and what they actually did. And he always went back on the 20-year scale for all these major companies. And I just put this up for you guys to Google it. You can run around the internet and take a look at it. But the internal rate of return that was promised and the internal rate of return that was actually done in whole life wasn't very good, just like it wasn't very good for the universal life policies. So with that, let me just talk about why I think it's so important to understand this stuff and what we can do going forward with analyzing portfolios and talking to these people about what they have currently. This slide is showing you what the difference is between the 1980 and the 2001 CSO table. And if you take a look at the males here, it's about a 30% discount. So anyone that had a policy that they purchased before January 1st, 2009, they can literally get a 30% discount on a newer policy. And keep in mind, and I have a whole presentation, Curtis and I did this a couple of years ago, we ran through whole life and we talked about what it is and what it is not. And I kind of sound a little negative talking about whole life here, but I want to just say, I do believe that whole life has a very, very strong place in the marketplace, as does index universal life. I do believe there's more people that have whole life that should have universal life than people that have universal life that should have whole life. I believe that very strongly. I'd like to talk to anybody about that and explain why. So that's what happened January 1st, 2009. Let me talk about the next one, because December of 2020, we had another CSO table change. And now we came across, and it's significantly cheaper again. So rather than having these two graphs overlay on each other, I just wanted to point out what exactly is happening here. This shows the 1980 table, the 2001 table, and the 2017 table. If you take a look at a 65-year-old, if someone has a policy they bought before January 1st, 2009, they're paying $97, per unit. If they switch to a new policy and they still got the same rating, they would pay $45. That's almost half. It's significantly cheaper. So that's why it's so important for people to look at, their older policies and make sure anyone you're talking to, even the younger people, talk to their parents, talk to their aunts, talk to their uncles, find out who has an older policy. And keep in mind that companies use their own numbers on the current sides of their illustrations, right? These numbers are used for guarantees, but these numbers are also used when it comes to planning the guaranteed side of their products and pricing new portfolios. So let's just talk real quick about whole life, and then we'll jump into some of the good stuff.
John, I'd like to pipe in here too, because one thing that that I wanted to get out to everybody today was we do have a policy review kit, and I kind of feel like with you talking about let me go and get this launched. But we're talking about the CSOs and the importance of policy reviews. There is a significant amount of opportunity out there in the marketplace, as I think you're articulating, to go in and review. And people, I think advisors in general would be shocked at some of these older policies to where you can come in and replace them with a better option, because you do get that pricing discount, even though the person is older.
Oh yeah, and it's interesting, Chris, if we can just get people to grab an in-force statement and then use your policy review kit. I'm not going to say it's a guaranteed sale, but can I throw my words practically guaranteed? If someone has an older policy and they're keeping it for death benefit, we can add at least a 50% increase to their death benefit and guarantee it. If you want to use a current assumption, we can do significantly better. And what I like about this slide is just talking about, why whole life looks so good and why whole life doesn't look so good. The risk of an insurance policy, as people get older, the risk of them dying obviously goes up. And I can't stand it when people tell me that whole life locks in your COIs. Whole life does not lock in your cost of insurance. It doesn't lock in your age. It locks in a death benefit and it locks in a guaranteed premium. It's a black box that you can't see, and you don't see what the cost of insurance are. But I'm here to tell you this. The fact that they use CVAT and we use GPT, it's a significant difference because the corridor is so much smaller on GPT. We can get more cash in there. And that may be a little complicated, and I'd love to do a little more deeper dive. Curtis and I did do a whole life versus universal life webinar years ago. We dove into that, what the difference is with CVAT and GPT. But for today, I'm just trying to focus on a couple other things, and I want to get into too much detail on this. But the whole life guys, they really love to talk about increasing COIs because they always say that they don't have an increasing COI. Well, they have an increasing COI, and I'll tell you this. We don't have nearly the increasing COI that they do. And let me explain to you why. If you take a look at this, it's all about the net amount at risk. If you have $1 million death benefit and you have zero cash value, you actually have to buy $1 million of insurance. Well, if you're buying $1 million of insurance at 10 cents per thousand, it's going to cost you $1,000. But think about this. Because we get to use GPT, and I'll explain this a little bit better on the next slide, because we get to use GPT, our corridor is smaller. So think about that. If we get to the point where we have a $900,000 cash value, we're only having to buy $100,000 of insurance. So $1 million is made up of mostly cash. So yeah, hold the whole life guys to say, oh, the cost of insurance goes through the roof on universal life as they get older. Yeah, it goes up. But think about this. Yeah, it tripled. But look at this. The money that comes out of the policy went from 1,000 to 280. And the fact that we get to put a much bigger cash value into that death benefit than whole life does, we can really minimize these fees. So that's all I want to say about that. It's a much more detailed conversation. But real quick, I'll just say this. On a 45-year-old, if you put $1 of cash in, you got to buy just about $2 worth of insurance on a universal life policy, and you have to buy significantly more on whole life. So enough about that. I want to segue that into 7702 and just chat a little bit about what happened with 7702, because that rule changed. That was December of 2022. And what's interesting is this thing just came in. Curtis, was that 2022 or 2021? I think it was, anyway, it doesn't matter. When we all know the 7702 rules change. Yeah. And I want to just go over real quick what that was and what happened. And it's interesting, this slide kind of says it all. And you'll see that these whole life policies, they're not that different on the base policy because they all use the government guidelines and they were mandated to use a 4% interest rate. So think about that. If they're all using 4% interest rates and they're all using, the government cost of insurance, the only difference is what they're going to charge for profit centers for themselves. So you can see they're all very similar. And if they go all the way up to just about the point where they're endowing, depending on their endowing, they're actually identical. And let's just say, so they're doing $1 million policy here. And it has to endow up here at 4%. Well, if the 7702, to just really dummy down this and make it super simple, it went from 4% to 2%. And a little side note here, we can talk quite a bit about what's happening now that the interest rates have gone up because that 2% was locked at the beginning, but it's a floating number going forward. And that's a whole nother presentation. But just to keep it simple, I want to say this. That 4% went to 2%. So if you're putting $19,560 in this policy to endow at 4%, obviously we have to put a lot more than 19,000 in, or you could say we get to put more in to make it endow at age 100 at 2%. Or the inverse of that is, well, we don't have to do $1 million policy if we're doing 2%. We can do 500,000 just to keep it simple, right? So think about that. That's what 7702 really did. And to me, it's a really important thing to understand because you have to understand what the different companies did to interpret that rule. There's only one company that came out 60 days later and literally applied that rule to their policies. So think about that. They cut their death benefits by 50%. And the cost of insurance on that, sure, they saved some money. But it didn't do much for the agent because they literally cut their comp by 50% and gave very little increase to the client. So think about this. You have $1 million policy. He's 45 years old. If you go look at your annual statement, there's probably a $600 cost of insurance in there. Well, we just cut that $600 cost of insurance down to $300 on a $19,000 premium. That's what I want you to think about. Was it really fair to give this client a slight increase and cut the agent by 50%? Just keep that in mind as we go forward. If you want to talk about that in some of the other slides and how other index companies, they interpreted that rule for themselves and what they did for their distribution and for their clients. Okay, and for you whole life advocates out there, one more slide, then I'll quit. Anyone ever heard of a company called Constellation? And if you go look at that, it's kind of interesting what they are and what they've done. And what happens in the whole life world is they always bash universal life and say, hey, it doesn't work because the cost of insurance goes up too much. We just chatted about that. They always say, look, you need to buy a policy that's non-direct recognition. That's the one where the dividends aren't going to change when you have loans. You have to buy a mutual company, and the policy owners own the company. And a lot of them are using this to bank on yourself. You've got your family bank, you've got Nelson and Pam Nash. Nelson Nash and Pam, what's her last name? I can't remember her last name right now. Anyway, they all loved a company called Ohio National. And that's what just blows me away. When you take a look at Ohio National and Minnesota Mutual, all the money that they put into these programs, I'm not going to say it's blown up, but it has not done well. And Ohio National is now owned by constellation. That's what it's owned by a private equity company, and that's where a lot of these people were doing their own banking. And that's just a whole conversation that I want to have with people, because just because you're with a mutual company doesn't make you immune to what can happen in this crazy world we're living in right now. Okay, now let's jump into why we're all here. Sorry about that, Curtis. I wanted to just go through that stuff. I think it's important for people to know that, because everybody will run into a whole life sometime, in their career. So why do we have AG 49? If we go take a look at what really happened, whole life sales were dropping. Carriers were getting upset, and they couldn't compete. So they came out and said, hey, we need to do something. This just isn't fair. So the NAIC developed, AG 49. The whole concept was to literally standardize the illustrations out there and make it so that one company couldn't just get more aggressive than others and really show some off-the-chart numbers, which is exactly what was happening. It was literally the Wild West out there. And, I had to work with all my staff and say, look, when an illustration comes in from these few carriers, please just take a look at age 65 and do a quick little calculation and say, hey, if this thing's over 12 or 13%, just send it over to me. And then I had to change it to 15% by the time it was said and done, because there's way too many of them. So anytime someone sent in an illustration that showed $1 million at age 65 and 150,000 tax-free coming out off $1 million for 30 years, and then the death benefit was magically $2 million after that, I had to call all those advisors and say, look, you need to dial back your illustrations, because your likelihood of success is probably, 40%, significantly lower than 50% for sure. And what does that really mean? Well, even if you were running policies, max funded, option B, but you were using best returns for the clients, it was amazing what people were doing out there, showing a 15% distribution, and the advisors had no idea. It turned out to be a great recruiting tool for us, because we were talking to agents saying, look, these other guys are running you these quotes, they're showing these crazy distributions, and your likelihood of success is so low. So we really needed to reel in these illustrations and show people what happened wasn't realistic, right? That if you take a look at what happened, was they were literally showing 3% arbitrages on the illustrated rate versus the cost of the loan. In other words, if you were showing a 7.5% illustrated rate of return over a 4.5% loan, that 3% arbitrage is what got us all in trouble, and that's why we had to have AG 49 come in and restrict the arbitrage on those. And we likelihood of success at 40% would scare the bejesus out of an advisor that thought he was running an illustration properly. He was just doing it as best he could, taking all the money out, and an advisor could come out and say, hey, I was running this thing the way it was designed in the policy, designed in the illustration software, and I've got a 40% likelihood of success. That would shock everybody. And what I want people to know is, it wasn't really their fault. They didn't understand what happened with the arbitrage on that. And then it came time to start comparing these policies. And I wish I could see you guys. I love to ask the question. Every time I do a seminar, I get in front of advisors, I want to say, how many of you have literally read a policy, read the agent's guide, and the actual contract, the life insurance policy itself? And very few of you are going to raise your hand for all three of those, and that's great for Curtis and I, because we'd probably be out of business if you guys all read all of those. So when it comes to comparing products, advisors, y'all want to do what's best for your client. In my world, we always want to put the client first, the insurance company second, and then we come in third. If we come in third, the insurance company is going to get the business that they want. They do it the right way, and the clients are always going to win, because we're not putting our pocketbooks out there front. And then the one thing that really drives me a bit nuts is, who's tried to read two illustrations and compare? I think I'm going to convince you in the next couple of slides that that's literally impossible to do unless you truly understand the inner workings and hidden mechanisms of the algorithms in these policies, and why the illustrated rate that you're punching into the computer has virtually nothing to do with the crediting rates of the policies putting into the cash values. That's a really important thing when it comes to AG 49, and why we have to understand how these things work, and more importantly, how they don't work. We can no longer come to any meaningful conclusion without additional information that you're not going to find in the agent's guide. You're not going to find it in the illustration. You're not going to find it when you're playing with the software. You have to understand what these actuaries are doing to make their illustrations look different than other carriers and be competitive, right? So the NAIC, they came out and they developed AG 49 to standardize the illustrations, and they really wanted to make sure that they had to get the right numbers out there and take that 15% down to something more reasonable. The intent was to make it in the 10% range, and it ended up in the 13% range. Again, it was a good recruiting tool. And let me go through this one. Index life is one of the most amazing savings tools we have out there. It's phenomenal to tell your clients, hey, we can protect yourself from Wall Street. We're not going to lose any money. It's really good to protect yourself from the government because you're not going to ever pay any taxes. And we have these opportunities for chronic and critical illness riders, all these living benefits that are associated with these policies. And again, not long-term care. Very few of these policies have long-term care. And Curtis, I think you probably know what's happening. There's dozens of states right now that are going to follow what Washington did with adding a income tax to cover long-term care. We sold tons of policies in Washington. That's going to come in a very big way very soon. So keep an eye out for Curtis to release some more information on selling policies that have true long-term care on them to help minimize their taxes and to give them their own portable product. Whole different presentation. Okay, so now why are we here? What I really want to do is just chat about what the policies do and don't do that IMS recommends, right? And there's so many things happening out in this world with competitiveness and policies that are changing. And it drives me nuts when a corporation, like a big insurance company, will fundamentally change their product to conform to a regulation that is 100% only for the illustration. It has nothing to do with how the policy performs, yet they'll change the way their policy is priced just to make it look better on an illustration. And my favorite line, Curtis mentioned at the beginning, do you want the best product or do you want the best illustration? So let's talk about this real quick. We had AG 49, and the intentions were to drive down the competitive nature, the ridiculous nature, and increase the likelihood of success. And the consequences were, as carriers were asked to reel in their illustrations, what they ended up doing was creating some pretty big problems for everybody. They took money and they created these other bonuses. They created these multipliers that really sent these things through the roof and destroyed the likelihood of success. So the intentions and the consequences of AG 49 were very different. So they had to come in with new intentions with AG 49A, and it was to reel in all those multipliers. And guess what happened with AG 49A? They came up with the volatility controlled indices. And for those of you that have been selling index universal life, you know that every single policy, every single company out there actually has volatility controlled indices as their default. And it's interesting to me because just because volatility controlled indices work so great in a volatile market, it doesn't mean that we should put all our money in there for the next 40, 50, 60 years. Absolutely not. We need to have a diversified allocation in our policies. But when we add a diversified allocation in our policies, i.e. on the illustration, it doesn't look as good. So there's a big, big black line there. And to me, I'll say this again later, but since it's on my mind now, I'll say it again here. The companies that allow you to illustrate with a single allocation, i.e. a volatility controlled index, but allow you to diversify on the application have a little bit of an advantage in my mind. Lots of companies have to have the illustration match the application, right? And if you're putting the volatility controlled index on the illustration to make it look best, that doesn't necessarily mean that's what's going to be best on the application for your clients, right? So keep that in mind. And the consequences of AG 49A were significant because everyone went to volatility controlled indices and added money for a bonus because the bonus was not included in AG 49, and we could circumvent the intent of the rule by adding the bonus to the illustration. I'll get to that in a minute. I have a couple of slides that show that. Then we have the intentions, what Curtis mentioned at the beginning. What are you trying to do with AG 49B? AG 49B is coming out, and what they're literally trying to do is stop the bonuses from cranking up the illustrations. And I'm trying to keep this really simple because I'll get into a much more detailed deal in 2 weeks. But AG 49B is set in place to really restrict the carriers and stop the bonuses, stop the multipliers, and stop the games from being played. And how they're going to do that is they literally are going to take whatever the company has to go out and hedge the product with, whatever their option budget is, whatever their portfolio rate of the company is, they're going to get a risk premium above that. They're going to get the ability to go at a very set rate above that, 145% of that. There are some other parts of the formula, but in a nutshell, if a company has the ability to go to the market and buy 5% options, pay 5% to go buy their caps, to go buy their volatility controlled indices, they're going to get 145% of that. Now, there's some other things that go on to that, but just to keep it simple, that's what it is. So what they're really trying to do is just stop all the nonsense out there. And again, it's going to really restrict what these carriers can do, and I'll talk about that in a minute because there's not a lot that they can do. Okay, and I really want to get into, well, let me just say this before I jump into the next slide. I want to talk about what the carriers have done, and just think about this, and I'm just going off my head here because I didn't have these slides put in here, but I want to just talk about it. If you think about AG 49, we used to illustrate at 8%. And then with AG 49, they went down to an average of about 6%. But distributions went through the roof. And as distributions went through the roof, it was very interesting because you would say if interest rates went down and distributions went through the roof, then fees must have gone down. Well, no, fees didn't go down. Fees went through the roof. And the reason fees went through the roof is because they're paying for these multipliers. And I have a couple other slides in here that actually, Curtis, I deleted the ones that I had the wrong presentation at first. I'm sorry about that. I want to say this. What's happening now is we're at a point where the regulators really want to just come in and take whatever the option budget is and give you a risk premium above that and come out with a uniform illustration kind of between all the companies. And if we take a look at the carriers now, at the top 10, the difference between the top 10 carriers is probably 40%. I think next week, the difference between the top 10 is going to be 10%. And I think the difference between the top 5 is going to be 3 to 5%. So think about that. You're going to run all these illustrations, and they're all going to be very similar. Why is that? I'll show you this. What's happening right now, if we take these rules and we just apply them to what's happening, the illustrated rate today for Allianz, for F&G, for John Hanger, for all these different companies, you can see what's going to happen. They're going to go from 7 to 5, 6 to 4, 5 to 6. That one's not big, but they're not that big in this space. The Builder plus IUL at North American 571 to 3.58. That would destroy the illustration, but that's not what's going to happen, because what's going to go, if you'll notice right here, every one of these carriers is using the volatility controlled index. And what's crazy is you'll all notice that as you're playing with the software, next week it's going to go from the volatility controlled index, and it's all going to go into the S&P 500. That's what's going to be a significant change. So don't panic, because if we went and applied a 7% down to a 5.7, if we went from a 6.62 to a 4.06, our distributions would drop 25 to 30%. So that's what's really happening here. The companies aren't just going to go, let this regulation change the way they're illustrating these products and have it drop significantly. So what's going to end up happening is, because the regulation says it's all based upon what you're going to the market with, right? If we're going to go to market with and buy the volatility controlled indices, that's a very small number. VCIs, the reason they came into vogue was because they're so inexpensive. They're so much cheaper than the S&P 500, and that freed up a lot of money for us to go out and add the bonuses. So what you're going to see is, these companies that have the 90-bit bonus, that have a 1% bonus, that have a 2.65% bonus, all these companies aren't going to illustrate those anymore because they can't. So what are they going to do? They're going to switch to the S&P 500. And if you went and applied and took a look at these carriers right now, they've got the ability to show these volatility controlled indices with a bonus. And you'll see that right now, I just ran all these different companies. I had to help from a couple of insurance companies. Most of it came from one. And I ran all these different numbers and showed what would happen to the policies. And what's interesting is it's 25 to 30%. But if we change the allocation and we go out and we show what would really happen with using the S&P, switching from the S&P to the S&P from the volatility controlled indices, our distributions are not going to drop that much. If you take a look at F&G, the max distribution here is 94, and it was going from 111 to 94. Allianz is going to go from 109 to 75. So they're going down significantly, but not, from 109 to 85. What's interesting is, this is the part that Curtis was talking about at the beginning. We're kind of jumping the gun a little bit because I don't have all the numbers yet for all the carriers. A lot of them haven't released everything. But I want to just get ahead of it and talk about it in terms of the way AG 49B is actually it's an amended version of AG 49A. AG 49B is literally take your option budget and you get a risk premium, a bonus above that, and that's what you're going to get to illustrate at. Most of these companies have roughly the same option budget, the portfolio rate, if you will. And if you take a look at it, the companies that have the biggest portfolio returns are the ones that are going to be able to buy the biggest caps, and they're the ones that are going to illustrate the best. But what's really going to come into play, in my opinion, is taking a look at the fees of the charges, the total sum of all the fees of these policies is going to really come into play. And I think next week we're going to see some huge jumps from companies that weren't even in the top 10 that are going to illustrate really well because they have a decent option budget and they have really low fees. And for example, a company that was designed to be a death benefit product could look really good because they have very small fees. They're not designed to have a high option budget. They're not designed to give big rates of return. The whole idea is that they're going to be coming out with a small fee and a comparable rate of return to everybody else and all of a sudden look really good. Does that mean that I would invest in them and put my money in them just because they look number one or number two? No, they're going to have the smallest fees, and fees aren't necessarily a bad thing. I mean, if you take a look at North American here, they've got big fees, but the reason they have big fees is because they have a giant bonus, and it's 100% sustainable by the company. And what I really like about it is, yeah, sure, they have an asset charge which makes these fees look crazy, but they also have the biggest bonus in the industry. And you'll notice that what's going to happen is those bonuses, those fees are going to go down because we're not going to be using a volatility controlled index, which are very inexpensive, which give a bigger bonus. I think that's all I want to say about that. For now, Curtis, should I add anything to that?
No, I think that was a good high level overview on what's going on, and I think it kind of goes back to what you'd mentioned, which is, we're just talking about illustrated changes, right? I mean, there's an expectation that you're going to see carriers do some different things from a structural standpoint, but we're probably a ways off from that. I mean, wouldn't you agree? I mean, that's not something that we're going to see next week or maybe even in the next month. Would be my
absolutely not. Yeah, no. It's well, I think that next Monday we're going to see some pretty big changes, and this is a slide. Can you see this slide?
Yeah.
Okay, this is what's really interesting. I want to just go through this real quick because I'm grabbing some slides that I didn't get a chance to go through here. Let me do this. Okay, what's interesting about this slide is this is what really talks about what happened with AG 49 and what happened all the way through all of the different systems that they've thrown at us. We used to illustrate at 8.43, and now they forced us to drop to 6.85. And the average loan before at 8.43 was 69,000. Well, then they went through the new regulations at us, and the 69,000 went to 84,000. What was insane was, before AG 49, we had the fees were at 72,000. They jumped to 200,000. Now, that 200,000 is ridiculous because of the $600,000 outlier, and I'm going to show you that in a minute here. But there's some pretty significant fee jumps here, from 187, from where they were, 72 to 187, 603. It's nuts to go change these fees this much. And that was kind of the problem. Then we had the AG 49. We brought in volatility controlled indices, and we were really dropped down. We went from 843 to 685 down to 589, and then the income still went up. It's still at 71,000, but the fees came way down because they just put the money into bonuses. And that was just always kind of a scary way to look at things. And I want to show this slide. And this is one of the biggest issues that I've had in the industry. This one just really bummed me out. I had one of my 20-year clients call me up and say, John, I need some help. I asked these guys for a 5% super conservative illustration. And look at this, so there's 400,000 in the policy, 5%. The basic index credit was $21,000, right? That was the 5%. So he thought he was illustrating at 5%. And this is why we have all these rule changes, right? What's interesting is I went and I showed him this page when he sent me the illustration. First of all, this 400,000 very conservative 5% illustrated rate. That's what the agency put in the software. So there it is. It's 21,000. But there's also a bonus of 38,000. So the total index credits were $60,000. So think about that. If he's showing 5% trying to be conservative, it's actually illustrating a 15%, right? Triple the 5. The problem was if he got a zero is not your hero. There's a $28,000 fee. That's a big, big problem for this, and that's why we keep seeing these changes. The companies play some pretty crazy games. And this is what it all comes down to for me. If a company has a basic portfolio rate of 5%, okay, they got a 5% rate. What can the companies do with 5? And this is the biggest thing that I always hear the naysayers about index life talk about. They'll say, look, how can you illustrate at 7% if you only have 5% to play with? That's a 40% rate of return. Who can make 40%? And it's because we're not investing, we're hedging. I think everybody on the phone, I hope you guys all understand just the basic workings of index life. You know, if you give a company $1,000, they take $950 and they invest it, so it goes back up to $1,000 at the end of the year. And they take that 5% and they go hedge it and they buy options. So if it goes up, we can get a 7 on the entire portfolio. That's the difference. That's the thing. This looks too good. It looks too good to be true. It probably is. Now, you need to understand how to explain that to your clients. That look, if we have a policy and we're able to go out and we can generate 5% with the entire portfolio of the company, we're going to invest that. And we can easily get 2%. Companies have done 2% ever since inception. They've done better than 2%. Then we have to subtract out the policy cost. And the best way to take a look at what policy costs are, this is a great little line. If someone says, what are the total fees in that policy? The best way to explain it is you show your illustrated rate of return, and so you're running it at 7, and you take your internal rate of return. If your internal rate of return is 6, and you had to use a 7 to get there, your fees are 1. So even if you have an expensive policy 20, 30 years down the road with a 1% fee, if you have a 5% portfolio, you're able to get an extra 2 on it, we can still show a net result of 6 to 6.5%. That's not too shabby. And that's what I don't like about a lot of these scams I see in the marketplace. I watch all the videos of what people are doing with index life, hyperfunding, and doing all this crazy stuff. We don't need to. What percentage of your money would you put into something that can net you 6 to 6.5% tax deferred? That's all we have to say. And Curtis, we're right up on the time limit here, so I want to be mindful of the 50 minutes here. So I guess I'll stop it right there and see if you have any questions you want to chat about.
Well, I appreciate you going through this last explanation, because I think that's a question that comes up, and certainly when you think about online, the proliferation of just content out there from all over the place about life insurance and life insurance being expensive. It's, well, expensive compared to what? And I think that one of the key differences there is articulating it as a percentage versus, on a cost surrender report, it's showing the hard dollar amount. And I think people, when they're trying to quantify that and asking questions of advisors, I think they can get bogged down in that, not realizing that, well, if we looked at other alternative investments as a hard dollar amount, even though it's what's listed as a percentage, I think it gets a little wonky. So I appreciate you going through that. Yeah, we are coming up on the hour here, and so I guess a couple things here, if I was going to round up, is as I think everybody on the call today can see, there's a lot of stuff going on right now in the marketplace. I also think that creates significant amounts of opportunity. I mean, we've seen so far, we're coming up on a third of the year over already. I mean, the responses that we're seeing on marketing, the level of engagement that we're seeing from consumers out there is at an all-time high. And so I think there's a ton of opportunity out there. We've been talking about an overfunded IUL presentation for an hour now. We haven't even gotten into legislative risk and tax changes and all of that that's up on the horizon as well. And so there's a lot of good reasons to utilize these products in a client's overall portfolio. I think the key thing as we go forward is, make sure you're engaging with the life sales team over here at IMS. There are a bunch of changes that are coming around on illustrated rates, and the team is very knowledgeable on all those topics and can work with you to make sure that we're getting the best option put together for you based off of what that client's goals are. Jon, I appreciate you taking some time out of your day to be with us this morning. It's always a pleasure. I always, even now, as long as I've known you, every time I get to hear you present, I pick up some gems that I hadn't heard you speak to before. So I really appreciate it.
Thank you, Curtis. And I want to just throw one more thing out there too, because what Curtis was just alluding to, and think about, again, my line, I've probably said it 2 or 3 times there is, do you want the best product or do you want the best illustration? Because they're definitely not the same thing. And please don't call one of Curtis's marketers and say, hey, send me 3 companies. I want to compare them. And if you do that, please call me with them and let me go through them with you and chat with why one would look better than the other. I mean, the whole point of it was to show you, Curtis does a lot of business with basically 4 companies. And there's a reason why the other 60 aren't on that list, right? I mean, that's a fair thing to say, I would say, Curtis, right?
Yeah.
And there's a reason for it. And I was going to show this one too. Let me just go through this slide. People hang up, if they hung on, Curtis, I want to just say this real quick. This is a really good illustration on why certain companies look better than others. And basically, in a nutshell, what I want to say is you can interpret things in 2 different ways. And if you had a company with a 12% cap and another company with a 10% cap and a 15% bonus, they both illustrate at 7, but very different how they look on an illustration, significantly different, because one that has a bonus gets to use the bonus, the one that doesn't get the cap, doesn't have the bonus, uses the cap. They're both showing 7, but 7 illustrates significantly higher. And there's so many little things like that in these illustrations that you need to understand so that we can teach you the best product, not the best illustration. And I'm not going to go into too much detail on that one, but I'll end it on that.
Well, good point. So what I would tell everybody is make sure to talk to the live sales team over here. Also, we're going to be doing another presentation here coming up in the future. So more to come on that once we get a date finalized on it. But I appreciate everybody taking some time this morning to be on the call with us, and I hope everybody has a wonderful week. Thanks.